Today is Friday, March 18th, and this is the ADM Investor Services Weekly Market Wrap-Up Report. We have Steve Freed and Alan Bush who are ready to discuss some of the markets that have been in the news this week. Steve Freed is the Vice President of Research at ADMIS, and Alan Bush is the Senior Financial Economist. Remember, the thoughts and opinions expressed in this video are those of the guests alone and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. Alan, the FOMC met this week. Please comment on the results of that meeting and Janet Yellen's comments.
Okay, well actually the meeting was very shocking as far as the outcome. The Fed at their meeting and in their statement indicated that they are only likely to raise the Fed funds rate 2 times this year. And if you recall, it was just last December that the Fed predicted that they would be able to raise rates 4 times this year.
So the U.S. dollar slipped due to a less hawkish policy statement this week. You've been predicting strength in the dollar to continue through 2016. Has your viewpoint on this been altered due to the less hawkish sentiment?
No, absolutely not. It has not changed. We have seen some price pressures with the Fed becoming a bit less hawkish, but we have come down now to a very significant support area, and even today the dollar is staging somewhat of a rebound. Also keep in mind that the Fed is still the most hawkish of all of the major central banks. The Fed will be raising most likely, I believe, at least 1 time this year. None of the other central banks will be able to raise rates at all this year, and the Bank of England is a distant second as far as hawkishness. They may be able to raise rates late in 2017.
Steve, do Fed comments impact the grain markets, and if so, how did this week's action affect grains and commodities in general?
Well, yeah, we definitely had a one-day impact, and with the dollar dropping as much as it did, we saw short covering come into the grains and buying in the beans, and also some buying in the corn. It was interesting, though, that we got up to price levels, $9 in the beans, $3.70 in the nearby corn, that triggered U.S. farmer selling.
That's good. Staying with the agriculturals for a moment, I know there have been some private estimates in regard to the U.S. 2016 crop. What are the analysts saying right now?
Well, we could have an early season this year with the warmer temperatures and the fact that we really didn't have that bad of a winter. So right now, farmers are getting into the fields. A few are even starting to plant corn. And we think that the analysts will say that there'll be more corn acres planted this year than last year, and that with wheat acres down, they might even plant more soybean acres this year than last year.
Brazil has been in the news a little bit in the political situation there. Is this impacting soybeans specifically?
When we had the break in the dollar and the rally in the real, and also some rally in the real due to the uncertainty of what's going on in Brazil, this slowed farmer selling in Brazil. And so that makes the U.S. a little bit more competitive on an export side, and China could come in and buy beans. The lower house of Brazil today decided to start proceedings to impeach their president.
As far as farmers right now in the marketplace, in your opinion, what should the farmer be doing right now from a risk management perspective?
You know, I think there's 3 things that farmers are looking at. Number 1 is that some of them are being forced to sell grain to pay for bills. And so they should replace those sold inventories with calls. And depending upon their risk management, how much they want to spend is what strike price they want to buy. And they don't really want to buy July because the analog years suggest that if weather turns bad, it'll be after the June expiration of the July options. And they don't want to go all the way out to new crop because they're paying for too much premium. So a lot of them are going into September and buying options that they can afford to protect against a weather rally.
Of course, the next big report is the March 31st report. Any analysts have some predictions on that as yet?
It should be a bearish report. They're going to say that corn stocks are equal to last year's record and bean and wheat stocks are above a year ago. And I think that from their ag forum numbers, they probably find a few more planted acres in the farmer official survey than what they said in February.
Alan, jumping back to the stock market, the S&P 500 futures jumped to new highs for the year this week. Is it too late to jump on this bandwagon? Can the investor look for a place to get long?
No, it is not too late. In fact, we did see a new high today in the overnight trade. And in fact, we are trading the S&P at new highs for the year. We believe that interest rates globally will stay very low for a very long period of time. So I think the bull market is still intact. And I think that this is a trend that will last all through this year as far as higher prices. As far as an entry point, I see very good support coming in around the 2,000 level in the June S&P. And that is really not that much lower, especially with the volatile trade that we have seen. So I would definitely be a buyer on breaks, and I think this is a trend that will last for quite some time.
Finally, guys, what's hot and what's not? I mean, we're talking crude, precious metals. What's out there right now?
Well, I think that, obviously what's been hot is crude, copper, sugar, gold, the U.S. stock market, and soybean oil. And what's interesting about this is that that's kind of a bigger basket of commodities than just short covering. So it could mean that we could be getting close to the end of the deflation trade. And so it still looks like these markets are still something that could go higher and are still hot. One of the things that were noted that's kind of off the radar is that India's fuel demand is up 12%. And so that is another thing that could help the gasoline market and also help the crude oil market. What's not is wheat. It's a weather market, and we had this week NOAA put out a 30-day outlook for rains in the southern plains. And so, we made new lows in the wheat market because of that. And also what's not hot is the bond market. And again, you're seeing maybe a shift of money away from risk to commodities and trying to start buying commodities.
And funds have been short in large numbers. And I guess if funds begin to start some short covering, that could further fuel a short-term rally in commodities?
It definitely could. And it also will increase trading interest, open interest, volume, and it kind of feeds on itself. Once you start getting over some of the simple moving averages like the 50 and the 100-day, and in some markets the 200-day moving average, that actually will bring in new buying.
Remember, the thoughts and opinions expressed on this video are those of the guests alone and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company.
And if you have any questions, comments, or want to talk further about these markets, contact us at www.admis.com.